Welcome to this tutorial. In this tutorial, we'll be learning on how to trade synthetic indices. So for those of us that doesn't know what synthetic indices are, they are assets, they are forex assets that are being engineered to look like they are being set to look like real life markets, but real life event does not affect it. For example, we are trading a US dollar slash maybe US dollar Japanese yen. All these news and some other factors can contribute to how the market behaves. So for example, if you are in a US dollar Japanese yen trade, and maybe there's a news that happens at maybe US, it eventually affects the way the market behaves. But in this case, there's nothing like that. So synthetic indices are not being affected by real life events, but they make it look like real life markets. So, and it's only exclusive to Deriv. So the broker that has it on their stock is Deriv. They are also known as binary. So today we'll be learning how to trade. Talking on how to trade synthetic indices. So synthetic indices, we have many synthetic indices assets that we can trade. The likes of volatilities. By clicking on this dollar sign, we'll see the asset that we can trade. Let's see. Starting from volatility 10, volatility 100, volatility 25, volatility 50. So we have a lot of them there that we can trade. But in all these assets, and let me add this one to it. Deriv just added some asset also. This let's say in the past let's say about 2 months ago now, they just added some assets. The likes of jump 10, jump 50, jump 25, jump 100. So they were not there before. They are just being added so that we can have many assets to trade. So these volatilities and the jumps, they behave the same way, and their movement looks like that of the normal currency market. So they move like currency pairs. Their volatility, the way they move like currency. So you can use the knowledge of currency pairs to also trade it. So after you've done analysis, but so that when you are dealing with synthetic indices, you don't need any fundamental analysis. What you need is only technical analysis. You make of the past price action. The way the price has behaved in the past to predict the future. So, but there's nothing like maybe news or economic. Also, you don't need all those stuff for synthetic indices, since they are not being affected by the real life events. So let's go back to the assets. So these are the assets we can trade under synthetic indices. We have the likes of volatility 10, volatility 100, 25, and so on. So, and each of these markets has their own lowest lot size that you can use for them. For example, now if you have to trade volatility 100, if I'm not mistaken, if you check the lowest lot size, it will be somewhere around 0.001, but volatility 50 is 0.30. So you have to first of all check the lowest lot size, so that you just go and you just go and set any lot size that can affect you. So if you are using 0.3 for volatility 100, that one is on the high side. So you must know the lowest lot size for each before you start trading. So you want to know that, you just go to your trade tab here. Let's say this volatility 50. You click on the trade, then you come here, you reduce it. The moment you start clicking on, and it's no more reflecting, no more changing the value here. We have 3.0 here. Let me point at it so that you see it. Talking about this section here, you have 3.0. So that's the lowest loss. The moment you increase it, you reduce it, and it's no more going anywhere, it's no more changing. Just know that that's the lowest loss size you can use for that particular asset. So for volatility 50, it is 3.0. So likewise, all those assets have their own lowest loss size that you can use for them. So in all these assets now, we have 4 unique assets there that you can't trade it anyhow. You must first of all understand it. It doesn't behave like normal currency, so you can't use the knowledge of currency to trade it. And they are the boom and crash. We have boom 1000, boom 500, crash 1000, and crash 500. Those 4 assets, you can't just trade them now. You have to understand how each of them works. But for crash 500 and crash 1000, they are the same thing. Their movement is the same thing. The only difference is that if you, for example, if you spend 2 minutes in a trade, in trading crash 1000, if you spend 2 minutes and you realize let's say $20 at the end of that trade, just know that if it were to be crash 500, you will have the double of that amount. So crash 500 will give you double of the amount. The way crash 500 moves is 2 times the movement of that of crash. So let me just put it that way. So for example, if you realize $2 for just one candlestick, depending on your lot size though. So if you use that same lot size for crash 500, you will realize $4. So just tell us that crash 500 will give you double of what crash 1000 will give you, and likewise also boom 500 will give you double of what boom 1000 will give you. So looking at this for these four assets now, let's start from crash 1000. Their chart is not the same thing, but their movement is the same thing. So for crash 500 and crash 1000, the normal trend how they move is uptrend. So whenever crash is on uptrend, that's the general trend for crash. But in between this movement, there's what we call spikes. You can see this candle is moving. Let me point so that you can understand what I'm saying. So this is the original movement, this is the normal movement, this is the trend for crash 500. It usually moves from down to up. So the normal trend is uptrend. So do you get it now? It usually move from up to, but in between we used to have what we call spikes. You can see all the spikes, they happen within seconds. No, normally the market is supposed to be moving candle by candle, candle by candle. This is 1 minute, this is 5 minutes time frame. Let me go to 1 minute so you understand what I'm saying. You can see the trend. So this is the normal trend. Sorry, let me point so that you can see it. This is the normal trend for crash. Crash usually starts from bottom to the up, so usually on uptrend. So if you are trading crash, you can trade both trend. You can trade the downtrend and the uptrend also, but the normal trend for crash is uptrend. So you can see how the candle moves little by little, but you can see all these red ones here. Sorry, you can see all these red ones here. It's all called spikes. These things, they happen within seconds. This is what makes crash 1000 and boom 1000, crash 500 and boom 500. This is what makes it different, because of these spikes. This thing happens within seconds. If it was to be a normal market, it should be going one by one, and the candle should be moving one by one. But in this case here, for the spikes, they happen within seconds. Let's see if there's, I think there's going to be a spike very soon, so you understand what I'm saying. It will happen, the red will just come, it can cover. So if you are trading crash 1000, you must be aware of all these spikes, so that you don't, the spike will not catch you. Because for example now, if you are to enter a trade somewhere around here, see here, you're already back some profit. So if a spike just catch a spike, just one spike, let's say the spike starts from here, it will move like this. The movement is within seconds. Can you get it? So it will cover the whole profit you've already earned from here to here. So it will cover it and to deduct it from your remaining distance. So it means if you don't have up to that amount, that means your account will be in you'll be in a floating loss. Do you get it now? So these spikes happen in between. So if you are trading, so the safest way of trading all this crash 1000, boom 1000 and the likes is by trading the spikes. But if you don't have a perfect strategy for it, you might end up losing your money. Because for example, let me say I'm already in the market. Let me place a buy trade. This is a for example, if it is to be a downtrend, you place a sell. it will be a down, it will be an uptrend, it will be an uptrend, you place a buy trade. So, and I told you crash is usually on an uptrend. So, although there will soon be a spike, because if we are to make our technical analysis, we've gotten to an area of value where the market has reached and it has come back. So very soon there will be a spike. So I want to intentionally make this spike to catch me, so you understand what I'm saying. Once you click on buy, so you are using lowest loss like this, which is 0.2 for crash 1000, boom 1000, and crash 500 and boom 500. So let's say I click on buy trade. I'm currently on a profit now. Gradually to be moving gradually. Can I see it? So that is how it will be moving. So I just want a spike to catch me, so that you understand what I'm saying. I've placed the buy trade here, so market is still going. Market is going. So let's just observe the market. I know very soon a spike will soon happen. So you see how the spike looks like. It happens within seconds, and when a spike occurs, it can cover a lot of candlesticks that you've already made as a profit. So by looking at this, let's go back to, let's also talk about boom 500. Boom is just the opposite of crash. I told you crash 500 and crash 1000, their normal trend is uptrend. It means if you want to trade the trend for crash 1000 and crash 500, you place a buy trade. But in the case of boom now, is the reverse is the case. So if you are to trade the trend, the normal trend for boom is downtrend. So you have to be selling to trade the trend of the boom 500 and boom 1000. So if I'm to go to the boom now, let me switch to boom, so you see what I'm saying. Let's look for boom 1000. So, and also boom 1000 and boom 500 will give you double of what boom 1000 will give you. So that's just that's the difference between the boom 1000 and boom 500. Boom 500 will give you double of whatever boom 1000 will give you, and crash 500 will give you double of whatever crash 1000 will give you. That's just the difference between the two. So let me load boom 500. So this is boom 500. So let's allow the chart to load. So can you see? So instead of it be going up, it's coming down. So the normal trend, the general trend for boom is usually down. To be selling, you have to be selling to make your money there. That's if you want to trade the trend. But you can see all these blue lines, that is because it's also called spikes. So the spike for boom 500 usually go up. It's just as if you are trading against the trend. So the spike of boom 500 usually in an uptrend. Why for boom 1000, for crash 500 and crash 1000, their spike is usually on a downtrend. So it's just the other way around. So it's as if you are trading against the trend. So if you are to trade the spikes, that means instead of selling boom, you will buy boom. Do you get what I'm saying now? So instead of normal trend for trading boom is by selling it. You sell because it's usually on a downtrend. But if you are the type that wants to trade the trend, that wants to trade against the trend, that is, you want to trade the spikes, and spikes give more money than trading trend. Because for example, if I enter a trade somewhere around here, so if you have to trade spike, let me just put this, if you have to trade spike, that means you have to enter before the spike happens, because spike usually happens in seconds. If I'm to enter this trade, I will have done my analysis and I will have known that there will be a spike very soon. Let me say I enter somewhere around here. So the price will have been reading loss for me. Like how many candles now? 1, 2, 3, 4, 5 candles. We have been in loss. But the moment this spike happens, this particular spike, the moment it happens, it will cover the whole loss and give me profit. Can you see that? Can you see how many candles this thing was able to cover in seconds? If you have to count it, all the profit, all the loss I've made from here will be covered and I will be in profit. So you can trade both. You can trade both the trend and both the spikes. So if you are trading if you are to trade the spikes, you have to make sure that boom is on an uptrend. Spikes for boom is usually on an uptrend. If boom is on a downtrend and you are trying to trade spike, you just lose your money. So you have to know the general trend by checking the higher time frame. Let's say like 1 hour, 2 hour, 4 hours time frame. You check the general trend. If boom is on a downtrend, just know you have to follow the trend. You sell for the trend. But if it's on an uptrend, you can place a buy trade. That is, you are buying the spikes. You are trading the spikes for boom. So if you are trading the spikes for boom, you place a buy trade. But if you want to trade the general trend, you place a sell trade. So sell, the normal trend for boom is sell. So while trading of the spike is buy. Why for crash 1000 and crash 500, the normal trend is uptrend. So it means if you want to trade the normal trend, you will place a buy trade. But if you want to trade the spikes, you place a sell trade. Let me check the this now enter the last time. Okay, it's still going, but there will soon be a spike very soon. I want a spike to catch me so that you can understand what I'm really saying. Let's just wait. A spike will soon occur. You can see I'm currently seeing like $80, 80 cents. I mean 80 cents on it because I'm using the lowest lot size. I don't mean I increased the lot size, so I've been more than that. But let's just keep watching. So instead of me waiting for spikes, let me go and check the general trend for the market by switching to an higher time frame. So let me check the general trend by let me use 1 hour. Let me use 1 hour time frame. So you can see the market has reached its peak, so it has to come down very soon. I know there will be a spike very soon. So let me go back to the 1 minute time frame. So the general trend for that market was an uptrend before, but the time the market has been on an uptrend for a long, so it's trying to, so it will come back to a downtrend very soon. So I see if you are trading the trend, it moves gradually. But once a spike just come in between, it can kick you off the market if you don't have an LD account, because it will happen in a seconds. So all these red lines you are seeing, you can see how they came down once. So it means trading of the spike is safer than trading of the trend. Can you see what just happened? I told you there will soon be a spike. You can see the spike happens within just a second, and you can see it. I was on profit before. Can you see? Let me check the particular. Can you see? I was seeing about just 80 cents. Guys, I'm now running a loss of minus 1.70 something dollar. So that's how you have to be careful. For trading from 500 500 and 1000 1000, you have to understand it very well. Although I'll still do a subsequent video on how you can analyze it very well, and I'll give you some indicator settings that will assist you in the analysis. But they are different. Those four assets, that's 500, cash 500, boom 1000 and cash 1000. You don't trade them the way you trade all the other assets. They have a specific way of doing their own, because there's what we call spikes. So presence of the spikes in this market make it unique, because for example, now if I'm to trade that spike, if I entered for a sell trade instead of buy around that same place, I'll be running like about 80 something 80 cent loss. But by the moment this spike happens, that will be a sell trade. The moment this spike happens, it will cover my loss and it will give me some profit. So the safest is by trading the spikes. So do you get it now? So the presence of spike in boom 1000, crash 1000, 500 and crash 500, that's what makes it unique. So you can't trade it anyhow, you can't trade it like others. But if I'm to go to volatility now, let's switch to volatility. Volatility behaves like normal currency market. So they move up and down, they go up and down. So once you do your analysis, you can just enter the trade. So I'll be dropping subsequent videos on each of these things, doing analysis. What you just do to be notified, just like this video and subscribe so that you can get notification of more subsequent videos. Thank you.